We have all felt the frustration of market guesswork. You watch a stock climb, you finally build up the courage to buy the breakout, and the very next day, the price plunges. You bought at the exact moment the trend reversed. By the end of this video, you will have a complete rule-based trading system plotted on your own charts to replace that reactive decision-making. We will build this system by combining two specific technical tools. We will use the long-term direction of trend lines and pair them with the short-term timing of moving averages. Replacing emotional reactions with visual mathematical rules provides a framework for managing capital and timing entries based on price data. First, open your charting platform. We need to add two specific overlays to the price data. Add a 200-period simple moving average, or SMA, and a 50-period exponential moving average, or EMA. The SMA averages closing prices over a set time frame, while the EMA applies more weight to the most recent price data. The 100 or 200-day moving averages are often slow to change, acting like an ocean tanker to define the macro trend. The 50-day EMA is more nimble, acting like a speedboat that reacts quickly to recent price changes for faster signals. Before we draw a single line, we must address a factor that can distort long-term trend analysis: standard arithmetic scales. This diagram compares an arithmetic scale on the left with a semi-log scale on the right. An arithmetic scale spaces out dollar values evenly. It makes a $10 move on a $10 stock look the same as a $10 move on a $100 stock. In reality, one is 100% gain and the other is just 10%. This visual distortion often leads to false breakout signals. Go into your chart settings and toggle the y-axis scale to semi-log. Notice how the arithmetic side shows the trend line breaking. The semi-log scale displays incremental values in percentage terms, which keeps the trend line intact and accurate. Without the correct moving average parameters and semi-log scaling, the baseline for your strategy is built on mathematically flawed visual data. Step 2 is establishing the baseline environment. Scan your charts for a stock that is currently trading above its 200-day SMA. Next, select the trend line tool. We want to draw a straight line that connects the higher lows of the current price action. A common mistake is drawing a line connecting only two price dips and assuming it will act as support. To validate the line, we need to see the price respect it. It takes 2 points to draw the initial line, but the third touch confirms it is true support. Watch the price drop to the line a third time and bounce. That is your confirmation. A validated 3-point trend line running above a 200-day SMA acts as a filter to ensure you aren't trading against the larger market direction. Now we wait for the trade setup. We look for the stock's price to pull back toward the moving averages, while still remaining above that validated trend line. This chart of Emerson Electric illustrates the trigger. The entry occurs at the specific point where the price line dips below the dashed green 50-day EMA and then crosses back above it. By widening the focus, you can see the solid red 200-day average holding steady far below the entry. Because the price remains above this long-term average, we ignore the minor bearish dips. This relationship keeps the trader in line with the primary trend. An entry point requires a predefined exit plan to be effective. We must define the risk. The moment you enter the trade, set a hard stop loss. This is a price level just below the validated trend line or the most recent swing low. If the price closes here, the setup is no longer valid. To take profits, you ride the trend until the price decisively closes below the 50-day EMA. The 50 EMA crossover provides the timing, while the exit rules define the risk. This framework moves the trade away from a prediction and toward a defined plan. This system works in harmony. The 200-day SMA and the 3-point trend line dictate the macro direction, while the 50-day EMA dictates the timing. Using verifiable parameters for entry, stop loss, and exit removes the need for hesitation during the trading process. For your homework, apply the 50 and 200 period averages to 3 different stocks on your platform. Practice identifying historical entry triggers that met all of these rules. Mastering this visual framework provides the structure needed to filter out market noise and execute a consistent trading strategy.